Welcome back. The screen is looking a lot brighter today if you are a bull, and it's a big move that we're seeing in the mid and small cap end of things. But remember, don't lose sight of the fact that these indices and a lot of stocks have taken a big knock from the top itself. So small cap and the mid cap indices, while they're at the day's high right now, 2.5% each. If you look up a longer chart, from their highs, the small cap index is down about 23-24%. The mid cap index itself, despite today's up move, is still down about 20% from its 52-week high. So in a situation like this, what are fund managers doing, specifically the ones who manage the small cap funds, and are there any interesting bets after this drubbing is something that we'll get chatting with Resham Jain of DSP Mutual Fund, who joins us now. Resham, of course, co-manages the small cap fund for DSP Mutual Fund itself. Thanks a lot, Resham. Thank you for joining in. There's a big fall that we've seen in the small cap and mid cap names. Of course, this after a big rise as well, when everyone was saying that valuations are, out of whack and all those things. Right now, with the valuations having moderated, with the sentiment having soured in this mid space, are there any pockets that you're liking? And what are you as a fund doing right now?
So thanks for inviting. I think a good day to be on the show. After a long time, we have seen market seeing some uptick. But I think, as you mentioned, market has corrected by almost 24% from peak. Some of the fall is also attributed to earning kind of moderating. We have seen last 3 quarters, the earning itself has seen earning growth itself has seen some level of moderation. So out of 24%, if I bifurcate, roughly around 8% fall is coming just because of earning degrowing or earning resetting at a lower level. And roughly around 16-17% fall is because of PE re-rating or de-rating in a way. And PE, let's say September 24, when market was at peak, was close to 24 times, which has now corrected to 20 times. And if you look at last 10 years average, it is close to 18 times. So maybe one can argue that market can come to averages if it falls by another 10% or so. So this is one part of the story. The second part of the story is that index has fallen by 24%, but a lot of stocks have fallen by 30, 40, 50%. And that is where the opportunity lies. So obviously there are pockets which were very, very expensive, like capital goods, which used to trade at 40 times, 50 times, 60 times. Some of the companies were valued at significantly more expensive. They have come less expensive now. They are still expensive than their past, but they are a little less expensive than what they used to be. I think the areas where we are seeing some level of opportunity is on the consumption side, the small ticket consumption, especially in the small cap universe. They took a very large beating. These are good companies, stable management. They are there from last many years. But in line with what the small cap universe have fallen, they have also took a beating. So that is one space where we see a good level of opportunity. There are also opportunities in the manufacturing space where whatever is happening geopolitically, and it has been happening since last many years. Some of these companies provide good opportunity, like textiles, chemicals, some of the forging, casting companies as well. So those are the pockets where we see opportunity. Obviously, we want to buy some of these good quality capital good companies. I think they have still not become cheap, but they have become more palatable. So from a 5-year perspective, if someone is looking at those companies, at least one can make money from these levels.
Resham, good afternoon. Thank you for joining in. So are you buying them when they are palatable, or still waiting for them to become cheaper? And how much more should they fall for them to fit your definition of cheap?
So I think there is this saying which says that when market goes up, you become quite optimistic, and when market falls, you become pessimist. So unlike that, I think obviously there is a lot of negativity right now in the market. And the only thing as an analyst or as a fund manager, what we need to look at is respect earnings. And so wherever we feel that earnings have been quite stable, despite the overall slowdown in a lot of sectors, we are going ahead and buying some of those names.
Are you buying newer names or are you topping up on names that you already have?
Both. So existing names, obviously, we become more happy when they fall because we anyways like them and they become more cheaper. So we like them and we buy those names. But on the other side, there are like this wish list. We want to buy those companies because of very good management, a very good business model. But because of valuation over the last 2-3 years, we couldn't participate in those names. Some of those names obviously have corrected, and those names are providing good opportunity.
Where would those wish lists stocks stand in your overall scheme of things when it comes to sectors? I'm not asking you for specific names, but if you could, guide the street into what is now, from your standpoint, looking a lot more attractive, new stuff.
So obviously, capital goods is one space definitely which has become much more palatable, which includes some of the industrial names as well. Healthcare is another sector where we see there is some correction which has happened, and valuations have also become much more palatable. And lastly, as I mentioned, consumption, because we have seen economy in a way over the last 3-4 years. A lot of capex driven things were happening, but there is incremental focus on consumption side as well. And some of those consumption names is where we are much more positive.
You hold RR Kabel as well in your portfolio, and recently there was a big announcement that came in from Ultratech. They wanted to enter the cables and wires space. Do you think what happened to the paints industry will happen to the cables and wire industry?
So typically, wherever you see faster growth, much longer growth, you will see players coming into those space. This is a very large sector. Obviously, there is a new player which is coming in, and obviously sentiments will get disrupted because of that, and that is what we have seen in some of the in the PE getting derated in some of those names. But I think over a 5 years, 10-year period, this is a space. If India has to grow, we need a lot of capex on the transmission side, on the overall power generation, power distribution side, and that is where these companies will keep growing. So obviously, some of these companies, because of recent sentiments, would correct. Probably that would provide more opportunity to look at that space.
All right, Resham, would have loved to chat with you a lot more, but due to paucity of time, we leave that for another day. Thank you so much for sparing time and joining us this afternoon there, Resham Jain of DSP Mutual Fund. Take a short break. The Nifty now nearing 22,400 as the short covering bounce continues on this midweek session. Stay tuned. We'll be right back.